In this video, I found 3 dominant growth companies that Wall Street has aggressively sold off, pushing their stocks down roughly 30% or more despite the fact that their long-term competitive positions remain intact. By the end of this video, you will understand why these businesses still control powerful platforms in massive markets and why this disconnect between price and underlying strength may be one of the most interesting opportunities in today's market. These are not speculative startups chasing trends. These are scaled platforms embedded in everyday commerce, restaurant infrastructure, and enterprise software. They benefit from network effects, switching costs, recurring revenue, and expanding total addressable markets. The headlines turned cautious. The fundamentals kept moving forward. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's start with the first company, DoorDash, ticker symbol DASH. To understand why DoorDash matters, you need to zoom out from the app icon on your phone and look at the structural shift happening in local commerce. Over the last decade, consumers have fundamentally changed how they purchase goods. Convenience is no longer a luxury. It is an expectation. Ordering food, groceries, and essentials through a mobile interface has become normalized behavior. DoorDash is not simply delivering meals, it is building the logistics layer for local businesses. Every time a customer places an order, DoorDash coordinates merchants, drivers, routing algorithms, payment systems, and customer communication in real time. That orchestration capability is extremely difficult to replicate at scale. The company operates a three-sided marketplace. Consumers want selection and fast delivery. Merchants want access to incremental demand. Drivers want flexible earning opportunities. The more participants on each side, the more valuable the network becomes. That flywheel strengthens over time. DoorDash established itself as the leader in the United States food delivery market by capturing a significant share of total order volume. Scale in delivery logistics is not just about branding. It directly impacts unit economics. When you have dense order flow in a geographic area, you reduce idle time for drivers. Reduced idle time improves delivery speed. Faster delivery increases customer satisfaction. Higher satisfaction drives repeat usage. That is operational leverage driven by network density. Now let's talk about the sell-off. Wall Street cooled on delivery stocks as pandemic-driven demand normalized. Investors feared that order growth would stall once consumers returned to dining out. There were concerns about profitability, regulatory scrutiny around gig workers, and competitive pricing pressure. The stock corrected sharply from prior highs, placing it among growth names that experienced significant multiple compression. But here is what matters. Revenue and total orders continued to grow even after peak pandemic conditions faded. Gross order value, which measures the total dollar value of transactions processed, reached tens of billions annually. That metric shows real economic throughput moving across the platform. DoorDash also expanded beyond restaurants. Grocery delivery, convenience stores, alcohol delivery in certain markets, and partnerships with large retailers broadened the addressable opportunity. This diversification reduces reliance on a single category and increases order frequency potential. Financially, the company has generated billions in annual revenue and has shown improvement in adjusted EBITDA. While net income has fluctuated due to investments and stock-based compensation, operating leverage has become more visible as order volume scales. A major underappreciated driver is advertising. Merchants compete for visibility within the app ecosystem. Sponsored listings and promotional placements create a higher margin revenue stream layered on top of transaction fees. As the merchant base expands, advertising monetization can meaningfully enhance profitability. Another structural advantage is data. DoorDash collects granular data on consumer preferences, peak ordering times, pricing elasticity, and delivery performance. That data improves routing algorithms and merchant recommendations. Over time, this creates a feedback loop that strengthens the platform. Critics argue that delivery margins are inherently thin. That is partially true at the transaction level, but scale, advertising, and operational efficiency can improve contribution margins over time. The question is not whether every individual order is highly profitable today. The question is whether the platform can compound cash flow as it matures. DoorDash has also invested in international expansion. While the United States remains its core market, expansion into other geographies increases long-term growth optionality. International markets may follow similar digital adoption curves, although competitive dynamics differ. Now consider the total addressable market. Food delivery penetration remains a fraction of overall restaurant spending. Grocery delivery penetration is even lower. If consumer behavior continues shifting toward on-demand fulfillment, the long-term opportunity remains substantial. One more critical factor is habit formation. Once consumers integrate delivery into weekly routines, churn declines. Subscription programs that offer delivery benefits further reinforce retention. Recurring engagement increases lifetime value per customer. Risk remains real. Regulatory changes regarding gig workers could impact cost structures. Economic slowdowns may reduce discretionary ordering. Competition could pressure take rates. But the dominant player with scale typically has advantages navigating those challenges. When Wall Street sees a stock down 30% or more, sentiment often drives the narrative. Long-term investors should instead evaluate competitive position, scalability, and structural trends. On those dimensions, DoorDash still holds meaningful strength. So the real question becomes valuation relative to growth durability. If the market priced DoorDash as a pandemic anomaly, yet the business continues expanding into a broader logistics infrastructure platform, that gap creates opportunity. Let's go deeper into DoorDash's economics because this is where long-term conviction is built. Marketplace businesses tend to follow a predictable path. Early stages prioritize growth and user acquisition. Middle stages focus on density and efficiency. Mature stages emphasize monetization and margin expansion. DoorDash appears to be transitioning from pure expansion to disciplined scaling. One metric investors should watch closely is contribution profit per order. As routing improves and advertising revenue increases, contribution margins can expand even if headline commission rates remain stable. That operational improvement is not always visible in short-term quarterly volatility. Cash flow generation is another key element. As capital intensity remains relatively low compared to asset-heavy logistics companies, incremental revenue can convert into free cash flow once fixed costs are covered. If the company maintains growth while improving operating leverage, valuation multiples may compress less dramatically than the market fears. DoorDash is also experimenting with white-label fulfillment services for merchants who want to manage their own ordering channels but rely on DoorDash logistics. That positions the company not just as a marketplace but as infrastructure. Infrastructure businesses, when scaled properly, often become durable compounding machines. They sit in the middle of economic activity and collect small fees across massive transaction volumes. Over time, that model can generate substantial cash flow. The market often overreacts to short-term deceleration. Growth rates naturally moderate as companies scale. A business growing from $1 billion to $2 billion doubles revenue. Growing from $10 billion to $15 billion is slower in percentage terms but adds more absolute dollars. Context matters. DoorDash is already operating at scale. The narrative shifted from hypergrowth to sustainable growth. That shift triggered multiple compression. But if revenue continues expanding and margins gradually improve, long-term intrinsic value may still rise meaningfully. As investors, we should separate price action from business trajectory. A stock chart showing a 30% decline does not automatically imply a deteriorating company. It may reflect changing risk appetite, macro conditions, or sentiment cycles. DoorDash still controls a leading position in a category reshaping local commerce. That does not guarantee outsized returns, but it does mean the business deserves analysis beyond short-term volatility. Now, before we move forward, let me briefly thank the sponsor of this video. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Toast, ticker symbol, TOST. To really understand Toast, you need to think about the restaurant industry from the inside out. Restaurants are operationally complex businesses. They manage front-of-house service, kitchen operations, supplier relationships, staff scheduling, payroll, online ordering, delivery integrations, loyalty programs, and customer data. Historically, many restaurants stitched these functions together using disconnected tools. One system handled payments, another handled scheduling, another handled online orders. Inventory might be tracked manually. Reporting was fragmented. Data lived in silos. Owners lacked a real-time, unified view of their business. Toast was built specifically to solve that fragmentation. Toast is not a generic point-of-sale provider. It is a purpose-built, cloud-based operating system designed exclusively for restaurants. That focus matters. When you specialize deeply in one vertical, you can build features that reflect the day-to-day realities of that industry. Restaurants operate on tight margins. Small inefficiencies can erode profitability quickly. A system that improves table turnover, reduces order errors, optimizes staffing levels, and tracks inventory accurately can materially impact the bottom line. That is where Toast's value proposition becomes powerful. The company generates revenue in multiple ways. It sells hardware such as terminals and handheld devices. It charges subscription fees for software modules, and it earns transaction-based revenue through integrated payment processing. This layered model increases average revenue per location over time. From a strategic standpoint, payment processing is especially important. As gross payment volume increases, Toast participates in that economic activity. The more transactions processed, the more recurring revenue flows to the platform. Wall Street turned cautious on Toast for several reasons. Concerns about consumer spending, small business resilience, and restaurant closures created uncertainty. Growth stocks more broadly experienced valuation compression. As a result, Toast's stock declined significantly from previous highs, placing it among companies down roughly 30% or more from peak levels. But when we examine operating performance rather than stock charts, a different picture emerges. Toast has continued expanding its number of restaurant locations using the platform. Each new location represents recurring subscription revenue plus payment processing flow. The installed base is a crucial driver because lifetime value per customer tends to increase as restaurants adopt additional modules. Another key metric is gross payment volume. This represents the total dollar amount of transactions flowing through Toast's system. As that volume scales into the tens of billions annually, it demonstrates real economic activity supported by the platform. Payment revenue scales alongside it. Revenue growth has remained strong, reaching billions in annual revenue. While the company previously reported net losses as it invested aggressively in expansion and sales infrastructure, there has been clear progress toward improving margins. Operating leverage becomes visible as fixed costs are spread across a larger base of locations. The moat here is rooted in integration and switching costs. When a restaurant adopts Toast, it integrates menus, pricing, employee management, payroll, analytics, loyalty programs, and payments into one unified system. Staff are trained on it. Historical sales data accumulates. Customer profiles are stored. Operational workflows are built around it. Switching to a new system would not simply mean replacing a payment terminal. It would require retraining employees, migrating data, reconfiguring menus, and potentially disrupting operations during the transition. For a small business operating on thin margins, that disruption carries real cost. That creates stickiness. Retention rates become critical in evaluating long-term potential. High retention combined with expanding average revenue per user creates durable recurring revenue growth. Toast has consistently emphasized its focus on increasing product adoption within existing customers, not just signing new locations. Another underappreciated opportunity is software upselling. Payroll management, marketing tools, financing solutions, and data analytics add incremental revenue streams. As restaurants grow comfortable with the core system, they are more likely to adopt adjacent services. The total addressable market remains substantial. There are hundreds of thousands of restaurant locations across North America and many more globally. Digital transformation within the industry is still underway. Many independent restaurants continue to operate with outdated systems or partially integrated solutions. Toast's specialization gives it a competitive advantage against more generalized providers. By tailoring the platform specifically to restaurant workflows, it builds features that directly address operational pain points. That differentiation strengthens its value proposition. Let's talk about unit economics. In the early stages, acquiring new restaurant customers requires upfront sales and installation costs. Hardware subsidies and onboarding expenses can weigh on margins. However, once a location is live and processing transactions, recurring revenue begins flowing monthly. Over time, as the installed base grows, incremental revenue carries higher contribution margins. This is classic software economics layered with transaction volume scaling. Another important factor is data. Because Toast processes transactions and tracks orders, it accumulates rich datasets on consumer preferences, peak ordering times, menu performance, and staffing efficiency. This data can be turned into actionable insights for restaurant owners. Better insights improve performance, which reinforces platform value. Wall Street may focus on quarterly net income fluctuations. Long-term investors should focus on revenue durability, gross payment volume growth, and operating leverage trajectory. Economic slowdowns can impact restaurant traffic. That risk is real. But restaurants are also resilient community businesses. Dining out is deeply embedded in social behavior. Over time, the industry continues evolving rather than disappearing. Additionally, Toast's exposure to quick service and fast casual segments provides some insulation. These categories often maintain traffic even during softer economic periods as consumers trade down from more expensive dining options. The company has also emphasized disciplined cost management as it matures. Growth at any cost has fallen out of favor in the market. Companies demonstrating a path toward sustainable profitability are rewarded with more stable multiples. If Toast can maintain healthy location growth, increase product adoption per location, and steadily expand margins, intrinsic value may grow even if sentiment remains cautious in the short term. It is important to recognize the structural shift occurring in small business software. Vertical SaaS companies that deeply understand specific industries often achieve stronger retention and pricing power than horizontal platforms. Toast exemplifies that vertical strategy. Investors sometimes underestimate the power of recurring revenue tied directly to transaction flow. As long as restaurants operate and process payments, Toast participates in that economic stream. Valuation compression created by macro fear does not automatically invalidate a business model. It may simply reflect changing risk premiums. When analyzing Toast, the core question is whether the platform continues embedding itself deeper into restaurant operations. So far, evidence suggests it is. Now let's move to the third company that Wall Street has cooled on despite the fact that it remains deeply embedded in the infrastructure of modern enterprises. ServiceNow, ticker symbol NOW. If DoorDash is building the logistics backbone for local commerce and Toast is building the operating system for restaurants, ServiceNow is building the digital nervous system for large organizations. Every major company today runs on workflows. Employees submit IT tickets. Human resources teams onboard new hires. Security teams respond to incidents. Customer service departments manage requests. Procurement teams approve purchases. Each of these actions follows a process. Historically, many of those processes were manual, fragmented, or built on legacy systems. ServiceNow unified them. At its core, ServiceNow provides a cloud-based platform that allows enterprises to design, automate, manage, and analyze workflows across departments. It started with IT service management, helping organizations handle technology incidents and support tickets. Over time, it expanded into human resources, customer service management, security operations, governance, risk, and more. This expansion matters because it transforms ServiceNow from a single function tool into a broad enterprise platform. Why does that create durability? Because once an organization standardizes workflows across thousands or even tens of thousands of employees, the platform becomes mission critical. It touches daily operations. Employees are trained on it. Data accumulates inside it. Integrations are built around it. Replacing it would not simply involve installing a new software package. It would require re-engineering processes, retraining staff, migrating historical records, and risking operational disruption. That creates powerful switching costs. Wall Street's sentiment toward growth stocks shifted as interest rates rose and valuation multiples compressed. Even high-quality enterprise software companies saw their stock prices pull back from prior peaks. ServiceNow experienced this broader repricing despite continuing to grow revenue at strong double-digit rates. The key is to separate market sentiment from operating performance. ServiceNow has consistently delivered robust subscription revenue growth. Subscription revenue forms the majority of total revenue, which creates predictable recurring cash flow. Enterprises typically sign multi-year contracts, increasing revenue visibility. Another crucial metric is remaining performance obligations. This represents contracted future revenue that has not yet been recognized. Growth in this metric indicates strong demand and backlog. It offers insight into forward revenue streams beyond a single quarter. ServiceNow's annual revenue has grown into the tens of billions of dollars. That level of scale combined with sustained growth is rare. Importantly, the company also generates significant operating margins and free cash flow. It is not a business relying solely on future promises. It already produces meaningful cash. Operating leverage in software can be powerful. Once the core platform is built, incremental customers add high-margin revenue. As ServiceNow expands into adjacent workflows within existing clients, customer lifetime value increases without proportionally increasing customer acquisition costs. Cross-sell and upsell dynamics are central to the thesis. A company might initially adopt ServiceNow for IT service management. Over time, it can layer on HR service delivery, customer workflows, security operations, and other modules. Each additional module deepens integration and increases switching costs. Digital transformation remains a strategic priority for enterprises. Even during economic slowdowns, companies seek efficiency gains and cost reduction. Workflow automation can reduce manual labor, minimize errors, and improve response times. That makes ServiceNow relevant not only in expansionary environments but also during cost optimization cycles. Risk exists, of course. Enterprise budgets can tighten, deal cycles can lengthen. Competition in enterprise software is intense. But ServiceNow's brand recognition, installed base, and platform breadth provide resilience. One of the most compelling aspects of ServiceNow is its ability to act as a central coordination layer across disparate systems. Large enterprises often run dozens or hundreds of specialized software tools. ServiceNow integrates with these systems and orchestrates processes between them. That central positioning enhances its strategic importance. Another long-term growth driver is international expansion. While the company has a strong presence in North America, global markets offer additional runway. As multinational corporations standardize processes across geographies, a unified workflow platform becomes increasingly attractive. Artificial intelligence and automation enhancements also represent opportunity. Embedding AI-driven insights into workflows can improve incident resolution, predict system failures, and automate repetitive tasks. This increases platform value without fundamentally changing the business model. Financial discipline further strengthens the case. ServiceNow has demonstrated consistent improvement in operating margins while continuing to invest in product development and sales. Free cash flow generation supports reinvestment, acquisitions, and balance sheet flexibility. When evaluating a company like ServiceNow, valuation should be viewed relative to growth durability and margin structure. High-quality recurring revenue businesses often command premium multiples. When those multiples compress due to macro conditions rather than business deterioration, long-term investors may find opportunity. Let's zoom out and compare all three companies discussed in this video. DoorDash operates a scaled logistics marketplace benefiting from network effects and increasing density. Its growth is tied to structural shifts in consumer behavior and local commerce digitization. Toast, ticker symbol 𝗣𝗟𝗏, builds a vertically integrated operating system for restaurants, generating recurring revenue through software subscriptions and payment processing tied directly to transaction flow. ServiceNow, ticker symbol NOW, powers enterprise workflow automation, generating predictable subscription revenue with high switching costs and strong free cash flow. All three operate platform models. All three benefit from recurring or transaction-based revenue. All three serve large and growing markets. And all three experience significant stock price pullbacks driven largely by macro concerns and valuation resets, rather than catastrophic business deterioration. That does not mean they are risk-free. Delivery economics, restaurant cyclicality, and enterprise spending cycles each present challenges. Execution matters. Competitive dynamics evolve, but the core competitive positions remain intact. When markets become risk-averse, they often sell growth stocks broadly. In those moments, long-term investors have an opportunity to analyze fundamentals calmly while sentiment fluctuates. The question is not whether these stocks will move next week. The question is whether these businesses can compound revenue and cash flow over the next 5 to 10 years. If DoorDash continues expanding categories and improving unit economics, if Toast deepens integration within restaurants and scales gross payment volume, and if ServiceNow continues embedding itself across enterprise workflows while generating strong cash flow, then intrinsic value may trend upward even if short-term volatility persists. Now I want to invite you to think critically. Which of these three companies do you believe has the most durable long-term advantage? Is it the network effects and marketplace density of DoorDash, the vertical specialization and switching costs of Toast, or the enterprise integration and recurring subscription strength of ServiceNow? Let me know in the comments and explain your reasoning. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.